It's mainstream. The AI theory of manipulation is mainstream now. So I
Yeah,
guess
just for the audience. So it's
I guess there's that.
he might have watched it with you because he had Chris Martinson on the show yesterday, who's a regular on my show. I only noticed it today, but for the audience, got to give Philip his flowers. So many of you, I thought he mentioned you. That's why he sent it to me. But Tucker did a video that went viral about how oil prices are being manipulated because of algorithmic trading and how Trump's post is a way to manipulate the algorithms. And the first person I've ever heard talk about this and asked him to jump on the show is Philip. And we kind of went through this a few weeks ago. And I've had you regularly since because it was the
Even if there wasn't an algorithm, tweets by Trump would still be manipulating market because regular people would have reacted that way. Even the age before there was AI algorithm, that's how the markets worked. Like even back in 2008, if the president makes a statement, the markets react.
audience loved it. You've done a great job at explaining it. Actually, maybe explain it again for people that missed that episode of ours. How and what Tucker was talking about. How are algorithms being manipulated? So I know about 70 or whatever percent, 80% of trades of oil futures are done by algorithms, and that's trading as a whole. Most of it's done by algorithms.
Very simple. Like I said, it used to be that president makes a statement, and humans, stock traders would see the statement, they would react a certain way. You can manipulate market that way. The algorithms are supposed to mimic what the human trader would do, which is react to news. It is essentially that. Trump makes a statement, and the algorithms think, oh, if we were real, actual people, we would react this way, and they trade the market like that.
Maybe 99% of it, if not 100% of it, will be done by algorithmic traders. And these algorithmic traders are not as advanced.
So the only thing that's changed is the speed. But when it was humans doing this might take half an hour, 2 hours for the full impact of a tweet to play out. But now when you have AI doing it, it's like 15 minutes.
We think they are, and they can easily be manipulated by Trump putting out a story saying we have a deal, imminent deal, or with Iran, or a lot of oil is flowing through the Strait of Hormuz. And those LLMs, those AI algorithmic traders, would essentially take that story that's on Axios or Fox News or whatever by the president, so treat it as a credible piece of news and act on that piece of news. And that's one way to manipulate those algorithms by the Trump administration. It's just not a sustainable way of doing it. But maybe let's start before going into whether this is all unraveling and your thoughts on the prices now. Maybe explain it better than I did to the audience on how the Trump administration can manipulate the markets.
Well, the first thing is Tucker did actually indirectly reference the first two interviews. So he actually got the source that he got was the UNS Review. The website, the UNS Review, did a very long post on the oil market. And the two interviews were embedded, so it was indirectly the two interviews that we did. So it's really cool to see a theory that actually, I've had this theory for longer than just the current crisis. I've been thinking about this since the beginning of the Red Sea crisis with the Houthis. I saw strong evidence this was taking place. So it's great to see it go mainstream. People thought it was a lunatic theory when I said it back around the time of the Red Sea. So basically, it's pretty straightforward, really. Oil traders. So the oil traders exist in various places, right? So there's various different types of oil traders. There's the oil traders that will work for companies that need to hedge oil prices, right? For example, so if you're a company that relies on an awful lot of energy input, for example, you'll have a specialized oil trading desk where you'll try and hedge out some oil price risk. Then there's the more speculative traders. You'll find them at like investment banks like JP Morgan, Goldman Sachs. And then there's the kind of most speculative of the bunch, and they're hedge funds, basically. Now, I'm most familiar with the hedge fund stuff. Never worked in hedge funds, but knew a lot of people in hedge funds. And interestingly, it was around the time of the complete takeoff of the algo manipulation that I was actually interviewing for a few hedge fund roles, and I noticed that this was taking place. So basically, in those markets, in the more investment bank ones and the hedge fund ones, they're not doing it to hedge out a position, right? They're doing it to make money, right?
Yeah, they don't look at the fundamentals. That means how good or bad a company is. It could be on the verge of bankruptcy or about to declare record profits. They don't care. All they care is, will its stock price go up and down? And can I trade that to make money?
Like any trader, like a day trader in stocks, day trader in Bitcoin, anything like that, right? And so they're using the usual mechanisms that you'll do in any day trading. Even if listeners do day trading themselves, they'll have a margin.
Looking at charts is one way to predict where something's going to go.
They'll usually be using leverage, and they'll be going long or going short the market, usually using puts and pulls and so on. And basically, the best oil traders were probably at hedge funds or investment banks. I guess they're probably equivalent, but they put a load of inputs into that. So, for example, they'll be watching the physical supply and demand and all that kind of thing, And they'll also be watching like the news, right? Is there a conflict taking off? Obviously relevant today. But even beyond that, like weather, extreme weather events, those kind of things. And there's lots of things that most people don't follow, which is kind of deep dive energy markets news, right? You have Chris Martinson is his name. I think you have on all the time. He's quite
there. Everyone knows about unemployment stats and the Fed rate cuts, but there's a whole bunch of other economic stats that are released periodically. Some of them even more and more obscure, but they trigger effects in market to the companies that are related to those stats, like inventory levels of oil for oil companies, as an example.
Quite familiar with the kind of deep dive literature. That's the kind of knowledge base that the average oil trader has. And basically what happened, it goes back about 10 years ago. I first started seeing the AI stuff creep into quantitative trading around 10 years ago, and I saw it being used for stocks. But it got really aggressive, I think, in the past 4 years, maybe 5. And basically what happened was people realized that you didn't actually need these guys watching these variables. All you had to kind of do was, program their brain into AI in effect. So you can formalize a lot of these trading rules.
Exactly. You hear what I said? You don't need the people. You used to have people that if they saw a bunch of news stories for a certain way, they'd trade a stock that way. And what he's saying is people realized they didn't need the people. They could just use AI to do the same thing, because honestly, what those particular people were doing was pretty simple. The point I'm making is the market would react to headlines and news in this way even before these algorithms existed. The market was being manipulated through the media even before this AI stuff. The AI stuff is just the way it works now. Instead of people, you have AI acting like the people used to.
So, for example, how much weight do you give to supply and demand dynamics versus how much do you give to forward-looking news, right? And you just put like a weight on that and feed it into an AI. My guess is as time went on, the AI started training itself, basically. And basically the way that would work is you'd program in the trading techniques of various oil traders at the beginning, and then you'd say to the AI, improve it. And it's very simple for the AI to do that. It just tests the rules, right? And it just consistently tests the rules and updates the ones that get the trade right. And my guess is that the direction that went in was putting vastly more emphasis over time on the news stories that were coming out. And of course, this is a self-reinforcing cycle, because then if the AI is training on it, then... So basically that's what happened. And the thing about these... So I'll give you an example from the stock market world, right? And I'll tell you from my own personal experience. When I was working for an investment firm, the quant guys that I knew, I didn't work on a team, but I knew the team quite well. We'd go out for drinks all the time and stuff like that. And they were telling me about this AI stuff that they were using for stocks back in, 2015, 2016, something like that. And I said, well, how does it work? Well, if you've ever heard of a 10K statement, right? It's the financial statement that companies have to upload.
Oh, yes, 10K.
At the end of the year, I'm supposed to upload it now. And it basically gives all the breakdown, their balance sheet, their income statements, all that. And that's how that's how stock market analysts analyze them. And what they said was basically they were automating the 10K statement reading, right? So what they do is they'd be looking for keywords in the statements that would correlate with stock moves in the past, if you see what I mean. And it was clever, I guess. So if it said tailwinds 10 times in the document, like that might be a bear signal. You know what I mean? The AI figures all this stuff out for you, But here's the thing,
just on that point, just to make it sure I understand, they're feeding all these company statements into the AI along with the stock movements, so the AI could see the correlation between certain keywords, certain statements, and the stocks, and that's how you would train those algorithms that are now being used at scale.
Yeah, just like you train any LLM, right? It's the same process. Text
and an LLM, LLM is large language model. It's essentially the foundation of how AI functions. Just for people that are not deep into this, every AI, ChatGPT, Grok, Claude, they're all LLMs. That's one way of looking at it.
So here's the interesting. This is a good way of telling the story because it highlights really well what's going on. Even when I saw that 10 years ago, me and the guys were in a bar or whatever, and I'd say, that's kind of clever. But what's going to happen, guys, right? And they're like, what? And I said, well,
the people doing the 10Ks will start manipulating you by putting in those words.
Soon the companies are going to hire you to recreate the 10K statement and make them bulletproof, right? It's the most obvious thing in the world. If you're going to lose, if your stock price is going to go down because you're saying tailwinds too much in your 10K statements, then you just hire the guys that are shorting it based on that, and you rejig your 10K statement.
Or you can hire the LLMs. You can also use the LLMs to rejig it as well, because the LLMs know what the LLMs look for. So AI would be used to kind of write these statements.
And if you are the head of a company and said, I want to buy some of the stock of my company for cheap, well, I'll just use the word tailspin 100 times in my 10K, and then when the AI stock's shorted, I'll just buy a bunch of stock. They're going to trade on such ridiculous information. People will manipulate it.
The trick the AIs that read those statements, and then all of it becomes a battle of AIs.
Mm-hmm. Exactly. And so it would run out quick. I was in financial markets, you call this the alpha, right? It's the return you get above the market average, right? And if you can get a clever quantitative model that generates alpha, you're happy because it's printing money for you effectively. And the thing with all alpha printing machines is they usually only last for a very short period of time because markets just figure it out, But I thought that this use of them on 10K statements would be shaken out pretty quick. Now, I didn't follow it, but I'd say they probably did get shaken out pretty quick. Now, the thing is, in the oil market, it's kind of a different game because 10K statements there's legal aspects to 10K statements. If you put out a company's earnings statement or whatever, you're subject to some rules, right, by the FCA or whatever. And you can't just start lying. You can't make stuff up. There's constraints. Now, if you're dealing with something like the oil market and the 10K statement is Trump's Truth Social, all bets are off, guys. He can say whatever he wants. He can tell you that the moon's made of cheese. And it doesn't matter. There's no FCA regulation. Same reason that there's so much insider trading going on in VC at the moment. It's not properly regulated, right? So there's this weird confluence between financial markets and politics where it's a Wild West. There's no rules to it. And so basically, it's the easiest thing in the world. You just reverse engineer the oil price and you embed in the statements that Trump's putting out, that the energy ministries are putting out, et cetera, and you just embed in them these keywords. And you go, oh man, that's crazy. Are you telling me a bunch of people are running LLMs at the Treasury? Dude, the guys who work at the Treasury cycle in and out of hedge funds, right? So it's the same guys. So
Yes. The Treasury is where I believe the root of the problem lies. That's where the Epstein crown really comes from, the U.S. Treasury.
You usually I never worked for government, but I worked with a bunch of people who worked for the Obama administration. So they go in, they do 2 or 3 years at the Treasury in whatever role, and then they go, and they're not getting paid great or whatever, but it's high prestige. And actually they often do it because they think it's prestige and they're going to get dates. It's actually hilarious if you inside stuff on this. It's kind of pathetic, but they do that and then they cycle back into the private sector. And that's where they make their money. And the two things reinforce one another. If you get a senior position at the Treasury, you're then worth more to a hedge fund or whatever because you'll have more knowledge of how the system works and all that kind of thing. So you're hiring the same guys and they're just going to bring the same mindset to the problem. Now, the issue is that you're dealing with fire here. This isn't like playing a game to get a few basis points alpha on a stock or something like that. You're playing with the world economy here. You're playing with the global oil supply. You're playing with the price of the key input in the entire economy. So that's basically, I think, what's going on.
On this subject, here's a video I want to watch from Bloomberg News, official mainstream news.
The Houthis are saying they targeted 2 Saudi oil tankers in the Red Sea. You had greater than even odds on this happening. It seems like it may be coming to fruition right now.
Right, Kaylee. I'm afraid it is. Round 2-0.
This is proof that the mainstream news is now switching into pushing oil upwards. They're now, if you look at oil price, they were pushing it down here. Now they're pushing it up.
Of the military conflict of this is going to be broader than probably round 1-0 was, unfortunately. The Houthis have the capability, we believe, to actually destroy the Yanbu terminal. That would even be worse. So in some ways, we would be lucky if all they did was take some shots at some ships and things. And hopefully that won't expand. And if they do, we can suppress that. But the risks are great, not only to shipping, but also to energy infrastructure, which on the oil side, so far, whether it's in the Gulf or the Red Sea, has avoided, damage.
Rapidan has had
So an AI that's listening, imagine how an AI is going to react listening to this short clip from Bloomberg.
the best analysis geopolitically and specific to the energy market since this started, Bob. You and your colleagues are experts on this, and I know that you probably don't want to be right about most of these things, but you've turned out to be. If 2.0 is worse than 1.0, do we retest the highs of $120 a barrel?
Yeah, I begin every briefing and comment.
Do we retest the highs 120? That would trigger something in the algos.
With I hope I'm wrong, you know, and I hope I'm wrong about what I'm about to say. Look.
And even for the humans watching it.
The reason we didn't go higher is we had some one-offs and some buffers that were used, strategic stocks. China went on a crash diet, but we know a crash diet, you can't live that way forever. When you come off of it, you're pretty hungry, and China's coming back. And we were able to sneak out some more oil in June. The military did a good job at that. But as we look into the fall, we've exhausted those buffers, and increasingly prices are going to have to do the work. So to answer your question, well, Rapidan, we're looking at a low $100 range, 100 to 110 in the coming weeks. But the risk is way to the upside, because even as we sit here today, even at $94 Brent, there's enormous optimism in the price. One of the distinctive features of this whole thing has been an entrenched optimism among traders. Look at equities, haven't even looked back since early April. And I think that optimism is unwarranted. And I think that bubble could burst. And if so, we're going to reprice much higher, I'm afraid.
But a lot of it could be dependent on China, as we don't have a lot of transparency into how much they had at the onset or how much they may have now. How much are they going to hold potentially in the way OPEC used to? The few.
I think that China reducing its demand was only for a short period of time, and it happened after Trump's trip to China. I think Trump's trip to China was to get China to reduce its oil input for just long enough for the United States to crash oil prices. Combined with oil coming out from the Strait of Hormuz, combined with SPR releases in the United States, all of those, they just managed to push it down to 170 briefly. And at this price, you had prime dealers, the Fed, the Treasury, whoever was in trouble in derivatives here, repositioned themselves, and now oil prices, actually, not only do they reposition themselves, now they're betting on oil prices going up to 150. Now that is how they make money. They might lose money if oil doesn't go up. So that's how you know it's going to go up.
Future of global energy prices, at least for a time, in their hands.
Well, so far they've been acting as that swing refiner, swing importer, if you will. Yeah. I think there were some reports that they actually resold some cargoes of crude they had bought. So, but we think at Rapid End, we think they're starting to come back. They want to resume this fall that SPR, strategic inventory filling. They're going to let their refiners make some money. They want to chase these record high refining margins. One of the reasons they cut back is they said their refiners, nope, we're going to cut back.
I will have you know that I made my prediction, if you remember, that oil would be above 150 by the end of August, while the MOU was still in effect, while there was still oil flowing through the Strait of Hormuz, while we were about like right here. I made the prediction. Now that the MOU's collapsed and we're back to full-scale war, 150 sounds much more reasonable and possible. But when I made my prediction, the MOU was still in force. You still had everyone talking about a glut of oil.
On imports. Well, now they're letting them chase those margins. So we think China's going to be creeping up in its imports by a couple million barrels a day into the fall. No sign they were willing to dump a lot of their strategic stocks. They're releasing some of them, but not a lot. So China only goes so far. And like I said, we've pretty much spent close to doing all the SPR releases. So we're out of buffers. Demand curtailment through price increases will have to do the work going forward if this persists.
The president said today, a short time ago in Georgia, that we don't need the straits, the word that he used. Realizing this is a global market, how could that be true?
Yeah, well, it's true in a physical sense. We don't import much from there. But it's incorrect in a price sense. As you say, the oil market is global. Supply disruption everywhere leads to a price increase.
Oh, yeah, if I haven't mentioned it, Houthis targeted 2 Saudi oil tankers in the Red Sea.
Everywhere, including here. Gasoline's now $4.06 and rising. Diesel's over $5 a gallon. The president has also learned and seen over and over again that when prices rise, it becomes an issue for us. And those strategic stocks aren't really about, or our import dependence, it's not so much about where we physically get the oil, right? Because we do import crude still. We get it from safe places. That hasn't been our issue. The issue is our vulnerability to these price shocks. Remember, we have low taxes, right? The rest of the world pays much higher tax. So they don't see that volatility. But we Americans, we see it in the pump price right away. Doesn't make us happy. So
what he's talking about is tax on gas. In Europe, in some places, you have more than 50% tax on gas when the gas is low. So when the gas price goes up, the tax stays more or less the same. And so maybe if oil prices goes up 50%, gas in Europe will go up 25% because taxes don't go up. And the part of the price component of gas price in Europe that's set by the actual price of oil and gas is like 50%, and the other 50% is tax. So if you increase 50%, you get on total 125, just a 25% increase. Sorry if I went fast there, but that's what he's saying is in the United States, when gas prices go up, it goes straight up. There's very small tax component to it. Let me see if I can find a graph of that while this continues.
We need Hormuz in the sense of we need stable oil prices.
Well, and you mentioned diesel prices. Obviously, a factor in that as well is Russia, which has had a number of refineries hit, which now has a ban on its own diesel exports, and which potentially, depending on the action of the United States Congress, could be facing tighter sanctions in the form of secondary tariffs that will be applied to buyers of its energy. We were told by Senator Rand Paul on Capitol Hill last night that sanctions package could lead to economic catastrophe for that reason. And I wonder how you're viewing it.
Well, I think the bill will also give...
Here we go. Petrol tax, dollar per gallon. United States, you see, it's less than $1, but like in Turkey, it's like $4 a gallon. It's a huge petrol tax in Germany, whatever. And when you have the Germany, you see $3. That's when oil is low. That's more than the cost of the gas. So someone in Germany, and gas prices, the actual cost of the gallon of gas is $2. They are still paying $5.20 because they're paying a $3.20 tax. Now, if gas prices go up to $4, that's 4 plus 3, that's 7. Like 7 is more than 5, but it's not that huge an increase. But if you're in the United States and it goes from 2 to 5, that's 2.5. That's a 150% increase. It's huge. That's what he was talking about. Anyway, continue.
Give the president some authority to implement it, and I think he'll use that and so forth. But you're right. Look, just as with crude oil, we had these offsets. With products, it went the wrong way. The second largest diesel exporter after the United States, Russia, 40%, 50% of its refining capacity is gone. It banned it. China, as I said earlier, they curtailed exports of refined products. So we kind of went negative. And if you look at those markets, it's a tale of two markets. Crude has been kept contained. It's starting to go up again. Refined products are super tight, margins at all-time highs, and rising still.
So we're seeing shares of Valero, Marathon hit new all-time highs on a daily basis. They have charts like tech companies right now. How vulnerable are we to a refining shock? We're walking into the real part of hurricane season. Any number of things could go wrong on the Gulf Coast when we have such limited capacity. You said it, $4.06. Where are we going for gas?
No, you're right. And my colleagues on the refining side and the oil side pointed out that when you run your refineries hot, and we have been, utilization rates at 95% persistently over and over again, I mean, you delay maintenance, you choose to run that refinery, but at some point, these refineries need work. They need downtime and repairs and things. And as we get into the fall, we're going to need to do that work. At the same time, these margins are going to be great. And then comes the risk of storms, unplanned outages. And we do see it's about 500,000 to 600,000 barrels a day of refining capacity is at risk to unplanned outages when you've sort of driven your refineries so hard for so long. So it is a precarious thing. You know, look, going into the July 4th weekend, it was a different world, right? Brent had retraced back to $70, and the market was betting on a sort of ballet, an elegant normalization of Hormuz just as these buffers wore off, and then hopefully kill that refining tightness.
And at that time, the people were thinking this, I was predicting $150 oil.
But it's not working out that way.
Okay. So I just want to show what's going through mainstream media. The stories the algorithms are reacting to are now positive, and they are pushing up the price of oil, which is why you see oil skyrocketing.
It's not the only thing that's going on. I saw in that interview that Martinson said, yes, I think that's correct, but there are also these big short dumps at key times. And there's an account on X called Dario something or other that tracks these. These are 100% happening. By the way, they were happening during the Houthi.
Can you explain them? Can you just explain them for the audience?
Yeah, so the short dumps, first of all, I have to say, I don't know where they're coming from. When you trick the algos, you're just tricking the algos across the board. So you're juicing the ones at the investment banks, you're juicing the ones at hedge funds. I don't know if the hedge guys at like actual companies are using algos. They might be, I don't know. So you're juicing all the algos across the board. You're just like programming the market. With the short positions, that's an active thing. You have to find someone to take those short positions. I don't know if that's the US Treasury. I don't know if the Treasury is leaning on some of the large investment banks, Goldman, JP, or something like that.
Exactly. This is what I don't know, too. For example, during the financial crisis, there was something called AIG Financial Products Units. That was the one that was going out and shorting commodities all over the place and doing all kinds of crazy things. Then AIG, that unit at AIG went under, and it was taken over by the Fed. The AIG's financial product became part of the Fed. Now, I don't know if they've outsourced what AIG Financial Products used to do to another firm out there, or if they're still running it, AIG's financial unit that's inside the Fed, or it's going on somewhere else. I just know it's happening. And that's how I was predicting that there was someone in big trouble in the derivatives markets. Since there's no transparency or honesty in like AIG's financial products unit, it's hard to know ahead of time where it's happening. But the big short positions that were being taken to manipulate oil, once crude fell all the way down here, they were able to cover their positions at a profit. They were bailed out by China reducing its imports, by oil flowing out of the straits, and by big SPR releases. That's how they pushed the market down, physical market.
the short positions. They could be, but somebody is doing these enormous
Just to be clear,
shorts.
short dumps, as in you're seeing a big amount of short positions come in at once. So someone is throwing money at suppressing the price of oil.
Yep.
Yeah, so
Correct?
with the algos, so I think I said last when we discussed this, it was something like, I don't know how much it's changed, but it was something like 95% short position, net short position in the oil market when all this craziness, or when we were midway through this craziness, and the oil price came down despite the fact the Strait was still basically closed. That was the oil glut era when Bloomberg were telling you there was an oil glut. Anyone remember that?
Yes.
The editors of Bloomberg, apparently. So
That's not what Bloomberg is saying these days about no mention of oil glut in that clip we just saw.
So there was 95% short positioning. Now here's the thing. With the trading manipulation, with the algo manipulation, you can get that 95% because you're just programming the market basically with keywords. But in order to really hammer the price, you have to make sure that no naughty long positions come into the market. Because if humans aren't tricked like the AI, so all the actual energy market guys are like, this is BS. Like, okay, there's a few out there who'll tell you it's not BS, but like loads of the energy guys think the market's broken. And so the logical thing for them to do is go in and take the other side of the trade, take the long position. Exactly. And eventually, if that long position starts building and the chatter starts going around the markets that it's all BS, like you could squeeze the shorts out of the market and the price could start to go up. So in order to stop that, you need tactical short trades, right? These are conscious trades. They're not algo manipulation. And what seems to be happening, and I've known before how you do this, you engage in these large short positions at very key times. So, for example, you engage in a large short position at the start of trading on Monday, because that'll actually indicate to the market that the week is going to be short. And a bunch of different algos called momentum algos will pick that up too. But the other trick that they're doing, and it's happening right now as we're talking, is you short.
You make the market go up and down a lot. Then what that does is someone who buys up here, then it goes down and the stop loss gets triggered and they get forced out. Stop losses are if my futures contract goes down to this amount, then sell. Traders are told to use this, are encouraged to use stop loss. And so with Trump's help, of course, setting the market up and down a lot, you can force longs out of the market.
Short the hell out of the oil market, especially on the Friday, to reset positions for the next week. And the real trick is you do it in hours where there's not that much trading. Like, think about it in human terms. On a Friday, guys on Wall Street, guys in hedge funds, whatever, they're going to knock off at about 4 or 5 o'clock, and they're going to go out for drinks with their friends. They're going to take their girlfriend for dinner, whatever, right? Even then, like, they work a lot, fine, but, you know, they tend to party hard too. So they go out on the weekends, right? So you go in at the end of that when trading's pretty thin, and you start dumping shorts into that market, and you can drive the price down significantly. Just before I came on, I saw that we can talk about recent developments, but the enormous increase in the oil price this week. It's now Friday. We're going into, I guess, Eastern time. We're going into these thinner trading times, thinner trading hours. And the price, I looked at Brent, it was down 3.8 just before I came on. That's it. That's what they're doing. Like, so that's what they do. You try and set it as low as possible through aggressive short positions on the Friday. You double down on that first thing on the Monday morning. And that sets the boundaries of the trading window for the rest of the week. Now, who the hell is taking these positions and taking the losses on these things? I don't know. Because every time you do that, you drive them down on Friday and then on Monday morning, oil price is still going to go up because, like, there's crises everywhere. But it has to go up from a lower base. So if you're going up from 90, it's going to go up, the end price is going to be less than if you go up from 100. But you're going up regardless, and whoever's put those short...
Well, the losses on those, haven't we also be talking about someone is insider trading and making a fortune on Wall Street? Maybe the person manipulating oil down and doing these short positions and taking these losses is also coordinating with Trump to make record profits from Trump's statements so they can recoup their losses from that.
Short positions in place are going to get murdered. So I don't know who's taking those losses. I mean, the speculation on Twitter is that the U.S. Treasury is taking those losses. I don't know. I mean, that seems weird to me, but it seems as equally as weird that there's a bunch of hedge funds or investment banks out there that are taking...
Well, again, who's taking those losses? Treasuries, but that Treasury is also making huge gain insider trading Trump's statements. So the two cancel each other out.
Taking these consistent hammer positions, like horrible losses every week. But someone's doing it, and you can see the trading in the market. There's a very clear pattern to it now. So that's basically how the futures prices are being manipulated. But, it's starting to break down because the crises in the world are becoming so intense. So, and we can live with that.
Yeah, or so on the tricking the algorithms.
It's not only that they've broken down; it's that the market has repositioned itself. They went to great lengths to create this. China, Trump's trip to China was to create this. He got China to reduce their imports. That was the sole reason for Trump's trip to China. Combine that with SPR releases, the signing of the memorandum of understanding and the flood of oil coming out from that, all of those combined to create this low price right here. And at this price, the Treasury and everyone, the key players on Wall Street, the Epstein crowd that couldn't afford to have oil go up higher, they have now repositioned themselves in derivative markets for higher oil prices. And that's where oil is heading.
Ways to trick algorithms, and then what these traders do, as institutions will do, is we'll just, hey, what's that one? Bring him. No, I want to see him.
Monty, you might come over here. Monty, come here.
Yeah, bring him. You can pet him and stuff. Guests do it all the time. Don't worry.
There you go. There we go.
Oh, man, it's adorable. That's adorable. I remember Joe Kent. I was doing an interview with Joe Kent, and then Cat started
very hairy dog
on his head. So on that front, so yeah, what happens is the people that manage those algorithms, whenever they find loopholes, they can spot them and they patch the algorithm. So there's always going to be weaknesses in the algorithms, ways to manipulate it, but it always gets patched. Like you say, the company reports they found that loophole and they patched it pretty quickly, and that's how markets work, even before algorithms. So in this case, what we've talked about.
You think it was obvious that information about stop loss orders was profitable? Yes, and your financial institution, if it's Goldman Sachs, JP Morgan, whatever, they know what your stop loss orders are. And I'm sure that wherever the AIG financial products unit is these days, those Epstein crowd traders, they get the information about stop loss orders from prime dealers. And so they know exactly what they need to hit to wipe out longs from the market.
And I saw the report, by the way, it's a pretty detailed report they did on UN's report, unz.com. It's a massive report. I saw interviews there called The Iran War and the Manipulation of Oil Markets. That's a massive report.
It's very good. It's very good. I'd really recommend it.
I've sent it to my team and my business partner. He's a private equity guy, and this is his life.
Okay, wait, what was that again?
Called The Iran War and the
Iran War and the Manipulation
of Oil Markets. That's a
of oil markets.
Massive report.
It's very good. It's very good. I'd really recommend
it. I've sent it to my team and my business partner. He's a private equity guy. This is his life. So the people caught onto that, and I'm sure they've patched the algorithms. So I think the strategy of manipulating the markets, they could easily change the way the algorithms interpret. And the algorithms are self-learning as well. So you could tell them like, hey, reduce the weighted the weighted importance of posts by Trump or anyone in his administration, because they could be, created just to mislead you. So that could be, these instructions could be added to the algorithm. Number one, the algorithm will also learn from these things as well. So when the algorithm sees Trump say a good thing, but then that thing not materialize time and time again, the algorithms are self-learning, it's always developing. So I think that loophole that you talked about is going to close up. We've talked about this already. It could be closing up as we speak. So that could be one reason why oil prices have gone up to the levels they are. Now, then the other question is like, all right, but why aren't oil prices $150, $120 a barrel? Well, on one side, there's a lot of indications this could escalate, but there's also a lot of people interpret this as Trump is preparing to tackle again, despite the threats, despite the military buildup. There is a lot of people that believe, because of the depleted munitions, political impact, the fact that military solutions just don't work, he will actually tackle. So the
thing is, the tackle this time will take time, because we've reached a point where Iran, in order for Trump to tackle, he will have to lift sanctions, unfreeze assets. And those will be politically difficult to do. He might need to go to Congress for lifting of sanctions, for example. And unfreezing of assets, again, very difficult politically. So he's not going to do it instantly. It's not like the Memorandum of Understanding where he could just go and sign the Versailles and just sign a piece of paper. He will actually have to take actions to get another opening of the Strait of Hormuz. Because Iran is willing to open the Strait of Hormuz if the United States lifts sanctions, recognizes it controls the Strait of Hormuz, and unfreezes assets. United States does those three, Iran will start letting traffic through the Strait of Hormuz again. But it's going to be very difficult for Trump to do those three things.
Maybe seeing the markets, this being the fundamental value of oil, because of the expectation that Trump will tackle. And just remember, the value of oil, of oil coming out of the Strait of Hormuz, if it wasn't for the war, it's $50. So a lot of people don't want to be holding oil, knowing that the fundamental value when everything clears and everything returns to normal, whether it's in a few months or whatever it is, the fundamental price of oil should be about $50, $60.
That, I believe, is propaganda, is Wall Street mainstream media propaganda. I'd say the maybe 60 and 70 might be what it was. It was at 60. So even before the war and going out longer term, yeah, you can't say, looking at this chart, that the long-term value of oil is 50, especially since inflation is happening every single year. The more dollars in circulation, I'd say it's like 65 maybe is what it would be without the closure of Strait of Hormuz, not 50. 50 that comes from the attempt to manipulate oil prices down. You have mainstream media and everyone repeat, oh, the normal natural price of oil is 50 all the way down here, and just to scare longs out of the market.
A barrel. So a lot of people see the price of oil as transitory, or the issues that are impacting the prices now as transitory.
On the thing about loophole closing, as I tried to say, like, it's not really like that when you're like ultra macro manipulating a market. The loophole closing works for like the 10K statement trick, right? Because you just get the algos on the other side and you have like a robot bottle or whatever you want to think about it. But with this, it's not that clear, because the point is, okay, so it's what I said about squeezing the longs out of the market, right? If all the algos are of 95% or 70% of the market is pointed in one direction, you make money if you follow the herd. If you try and like do your algo to be more realistic, you'll just get scammed, right?
I will offer a little contradiction here. Yes, as joining the stampede, yeah, it's good. But the point at which the market's highs are hit, it's when everyone believes that the market's going up, when everyone is bullish, everyone is optimistic, and everyone has already bought into the market. There's no more buyers left. There's no one left to come in to buy more and send it higher. So that is actually the height of market. And same thing for the lows. When panic is at the extreme and market has crashed, everyone is selling, more people sell, it keeps on going down, down, down. And when everyone is bearish, everyone who is afraid has sold, and there's no one left, there's practically everyone who's in the market now is no longer, is not going to sell no matter what. That is the low. So to some extent, if you want to make a lot of money, you have to time those tops and bottoms right and go against the herd.
So it's like, it's trading momentum. Like if you're in a huge market, think of it if you're in a huge market bubble, right? Imagine you're in the dot-com bubble in 1999, early 99, late 1998 or something like that. And you go, I've looked at the fundamental values of these companies. It's all BS. Pets.com is fake. Some of it's like Bernie Madoff scams. Like, it's completely retarded. Like, why are we doing this? Great. You're very clever. Congratulations on being very clever. Now you take a short position in the market and you get wrecked because the bubble just keeps inflating.
Yes, markets can stay irrational longer than you can keep solvent. That means it bubbles. Yes, in a stock market bubble, you can tell, oh, okay, this is a bubble. It price shouldn't be here. And if you short it there, well, the bubble might go a lot higher for a lot longer. So timing the top is very important. And the top, where you time the top, is when everyone is bullish. When everyone is saying, oh, it's going to go to the moon. And there's no more naysayers. That's the top. And that's why you could tell this was really the bottom of the oil. You had everyone talking about an oil glut and everyone, yeah, this was definitely a big bottom.
Right? It's the same dynamic for this. So it doesn't work in that kind of arbitrage way that manipulating 10K statements or temporary alpha generation or whatever. And this is a big, like, I mean, not to get into financial economics too much, but this is a big criticism actually of the efficient markets hypothesis. That the efficient markets hypothesis, I won't go into it, basically says that markets price these things in very well. Robot wars, like we just discussed, often flush the gunk out of the system. That kind of works
always reverts to the mean, to the fundamental price of an asset, away from all the emotions and the way to manipulate it.
That works across, you can think of it horizontally, but vertically, it doesn't really work. And what I mean by that is if you're in a massive bubble, like the dot-com bubble, it doesn't work for that. Like, the momentum of the market just keeps driving forward. You could say that potentially about the AI sector at the moment, although that's a bit more controversial. And you could definitely say that for example, the mortgage-backed security market in 2008. Yeah, like, people could have figured out that I shall tell you, I know the guy that was running the MBS desk at Bank of America.
Back then, I warned people about that bank stocks are going to crash. And yeah, I'm actually going to look for that right now.
Yeah. He knew it was a BS, right? He actually quit during it.
The mortgage-backed securities in the global financial crisis.
Yeah, he was running the fixed income desk. He's a good friend of mine. This isn't a secret. He's written about it. He ran the MBS desk back in 2008. He quit because he was convinced that everyone was going to get arrested. He thought it was illegal. It was illegal what was going on. But the point is, like, you knew. But the old saying at the time was IBJ, UBJ. I'll be gone, you be gone, right? So you'll be gone by the time it happens. So, and that's the point. Like, when a momentum develops into a market, a kind of a hysteria.
Old emails. October 2007 emails warning about the stock market crash. So this is me warning about that. Oh, look at the emails about the 2008 oil bubble. Forced selling has already started and it's going to get worse. If you look at the chart of oil from that time. Okay, let's see. Can I zoom in to here? Well, yeah, that's good enough. 5/24, 2008. Okay. So, right here, I was sending emails about oil prices crashing. Oil going under 50. I've been accurate before, is all I'm saying.
Area or a bubble or something like that. You can't fight it. And what they're doing is they're creating an artificial bubble here. And so I don't think there is a kind of arb opportunity. It only breaks when it breaks. And this week we saw some serious cracks. Now, as I said, just before I came on, Brent fell something like 3.2, 3.8, something like that. And that's the manipulation short squeeze, the short dump coming in on Friday. And there'll be probably another one on Monday morning. It's so predictable at this point. But the fundamentals are really shining through now. It's getting really, really difficult. So I actually got some really good, I think some good numbers. I'll just share them with you. I don't have anything to share on screen or anything, but just think about this, right? So the manipulation is one rung of controlling the situation. That keeps WTI, Brent, futures prices, etc. down. And that, has a variety of different effects. It definitely somewhat impacts gas prices at the pump, not that much, but somewhat impacts. I think a lot of it's for psychological control. I think a lot of it's to communicate to the president, to be frank, that nothing's wrong. But the other component of this price control or oil supply management.
That's why oil shortages are going to send the price high so fast. Is once it happens, once flights get canceled for lack of jet fuel, once there starts being a diesel shortage, it's impossible to hide. It's absolutely impossible to hide today with social media. And panic will spread and people will stop believing Trump, which will accelerate the panic. And that will really start driving the price up.
Strategy is the SPR dumps, the dumps from the Strategic Petroleum Reserve in the United States. Now, just very quickly, these are going to become even more important shortly because I saw that the Russians are taking oil that was previously going into the world market and giving it to the Chinese, and this will feed into the stats I'm going to tell you. So
really,
that's going to push Europe to try and import more from America. And what happens there is the SPR dumps onto the market, and then a significant amount just goes over to Europe. And what they're basically doing is subsidizing European energy costs. And this is what happens if you have an open global market in the commodity. If you try and price suppress domestically, it's like there's this arbitrage opportunity. I think it's
until you get export restrictions and other direct government interference. But as long as Trump isn't doing that, yes, it's completely global market, and that's what happens.
Between two of the Scandinavian countries, I can't remember. I think it's Norway and Sweden. And Sweden subsidizes babies' nappies, diapers, right? And so people go across because they're very expensive, actually. So people go across the border and they load the car up with nappies. It seems ridiculous, but that happens. Another one, in Ireland, where I grew up, anytime sterling fell significantly, people would race across the Northern Irish border, which is, of course, British territory, and they'd buy up cigarettes and alcohol. The whole car would be full of it because there was a free trade zone, right? There'd be an arbitrage opportunity. So basically, that's what's happening with the SPR dumps. So now consider some of these stats, right? So when I looked at this at the start of the week, the SPR was around 316 million barrels that were left. And I figured out that on average, the US government has been dumping around 7.6 million barrels a week onto the market. Maybe that should be, no, this is a week. And some of this, of course, is being exported. Now, look, here's the interesting thing. The SPR has two minimums. I think you've probably heard this on the show before, but just to remind people, the congressionally mandated minimum, and that's there basically to say, we need the rest of that stuff in case we have hurricanes, full-on World War III, whatever. And that congressionally mandated minimum is 243 million barrels, right? At the current rate of drawdown, just at the current rate, 7.6 million, that will be hit. That minimum will be hit in 9 to 10 weeks. So that'll be hit in mid-September, before the midterms. The other minimum on the SPR is the physical or operational minimum. And this is when the SPR, which is basically a bunch of salt caves, starts to malfunction because there's just not enough oil there, and the pressure in the system leads to kind of a collapsing of the caves themselves. Now, here's the interest. So, first of all, I should say the official physical or operational minimum is 150 million barrels, right? At current rates of drawdown, the SPR will hit that in 22 weeks. So that'll be by the end of December. So after the midterms. Now, here's the interesting thing. I saw an official come out this week and say, that's not the actual operational minimum. Actual operational minimum is 70 million. They're halving the operational minimum. That's desperation. If that continues, if that trend continues with the administration, they are going to really destroy something just to keep the lights on. But here's the interesting thing.
Which is possible. It is possible.
Things. Now, the factoring in the decline in oil supply from the closure of the Bab el-Mandeb Strait is a little tough, okay? Like, we have to see what happens there. It's significant. It's basically doubled, not doubled, but it's almost doubled the pressure on Middle Eastern energy supplies. But one that's actually very easy to calculate is the return of the Chinese to the market, right? So as people probably know, the Chinese were importing 12 million barrels a day before the crisis. And then I think over a deal with the Trump administration, over the MOU, they gave the Trump administration a 60-day time horizon to try and sort it out. And they halved their oil imports from 12 million barrels to around 6 million barrels. But now that the MOU hasn't worked, the Chinese are re-entering the market. Initial estimates, I think you've had this on the show before, are now 9 million. So they're back up halfway. They'll get back up to 12. There's no reason they won't. Now, here's the interesting thing. If you factor those into the calculations that I did, the SPR goes from, remember, the congressionally mandated minimum, that's the official minimum, that was supposed to be 9 to 10 weeks, mid-September, right, at current rates. If you factor in the Chinese imports, that goes down to 4 to 5 weeks. So late August.
Because the US, because you're saying if the Chinese start to buy up oil, then there will be less supply in the markets that the US has to fill for the Europeans and for the Asians.
Yeah, and even for themselves, just to keep the market afloat, because the manipulation of the futures price doesn't actually put gas in your car, right? So there's a dual thing going on.
You mean there'll be less oil that the Americans could buy because a lot of it is being diverted to China? If the Chinese,
yes, exactly, or the rest of the world. And so the pressure on the price will be so much they'll have to release more of the SPR. So with the Chinese releases, I think congressionally approved minimum is reached in 4 to 5 weeks, late August, like really soon, like a month from now. And then the operational minimum will be hit not in 22 weeks, but in 11 weeks. So by the start of October, before the midterms. I think the Trump administration has screwed up royally here. I think they had a plan in place, not a very good plan, but at least a somewhat coherent, sustainable plan.
Well, if their plan was just to get a crash in oil prices so that Treasury could reposition, then they accomplished what they wanted to, like in the week or two after the MOU, and now.
Did you say the congressional reserves, when do you think they'll run out?
11 weeks.
Buying up, with the Chinese coming in, yeah?
11 weeks. So before the midterms, October. Unless something changes or they...
That's with the Chinese coming in, yeah?
With the Chinese coming in, 11 weeks. Without that 22 and you get past the midterms. Now, look, you can tea leaf read these numbers. Imagine you're the Trump administration at the beginning of this whole thing. And you say, right, we need to get it over the line for the midterms. What do we do? Okay, we go and do this Beijing meeting. We give the Chinese whatever they gave the Chinese, whatever they want to Taiwan, something, I don't know. And the Chinese will give us respite for 60 days. They do a calculation. They say, that'll get us up to the midterms, sir. And Trump goes, great, let's do that. They do that. They have some sort of a plan in place. I'm speculating, but this is pretty obvious to me. They have some sort of a plan in place. So they put the MOU in place. They agree with the Chinese to halve their energy imports. They do the maths on it, and they realize that will take the energy markets to be secure at least up until the midterms, right? With the MOU in place and the Chinese halving their imports. But because the Trump administration is so chaotic, and because Trump himself is so chaotic, and because he doesn't think about details ever, he tears up the MOU, right? A couple of weeks ago, 2 weeks ago, 3 weeks ago. And now the whole plan's effed, right? The whole plan makes no sense anymore. The numbers don't work. This is classic Trump administration to me. So some guy, some poor nerdy economist or something at the Treasury, who put all this work into making a coherent plan to get the administration up to the elections, up to the midterms, pushing every button, manipulating algorithms, winding down the SPR in ways that are completely irresponsible, whatever it takes. He put together that plan. It required the China.
Thing is, other places like Europe had strategic oil reserves too that were releasing. Just because the United States strategic oil reserves last longer, if Europe's reserves run out, then they'll start importing more, and that'll put a greater drain on U.S. reserves. So I think he's being too optimistic here.
Chinese to buy half. It also required the Bab el-Mandeb Strait to be open. I'm not even factoring that in, so the situation's probably worse. Trump tears up the MOU, the Chinese go F this, and the Houthis close the Bab el-Mandeb Strait.
Here. Strategic oil reserves. This is old, so it's not accurate. We don't have this much in the reserves anymore. But the point I'm making is all these other governments, like all these places in Europe, have small strategic reserves, France, Germany, and those are running down too. And they'll run out before the United States. And that's why I think that once one country like Germany oil reserves run out, they're going to be importing far more gas. And that'll a lot of that come from the United States. So the U.S. reserves gets drawn down faster. So I think he's being too optimistic if he's just looking at U.S. reserves.
Time limit.
Just to be clear, the Bab el-Mandeb Strait is not closed, just closed for Saudi ships.
It's partially closed. There's a lot less going through. I saw there is some Chinese, Asian ships and stuff going through. But anyway, look, I'm not even factoring it into those numbers because, as I said, that's more difficult to predict. The Chinese, going back to their normal levels, it's not difficult because it's 12 million. We know what it is. So I think what they've done is they've destroyed their plan. I think they had a coherent midterms plan, and it was given to Trump. It was sold to Trump. Trump doesn't like details. He just wants to know his plan. They go over to Beijing. They get the plan done. Then Trump, hasn't, bad day or whatever, drives the motivations, and tears up the MOU and says, I'm going to crush their civilization or whatever. And they're the plans on the fire. And that's where they are. And I think that they're sailing blind. And also, as we've discussed before, I don't think the Iranians are in the mood to talk anymore. And some of the strikes on the basis now, like casualty reports are fake, man. If you've seen those photos of them hitting dormitories, okay, that's not 4 people. So it's getting pretty hot. And the thing is, the Iranians know well. Why weren't they hitting those dormitories before? They're perfectly capable of doing it because they're nice, ethical people. No, they're not doing it because they know it's going to drive the Americans wild. If you hit those dormitories and you start sending body bags back to the US, you're escalating. You're then putting the administration in a position, even if they're not admitting to the casualties, where they're just going to escalate. The Iranians are saying, come get it now. That's what they're doing. And I think the plan is on the fire. I don't think there's any plan for the midterms anymore. And we're just walking off an energy cliff.
That's it.
And perhaps that was the goal of the Iran war, is to trick Trump into self-destructing his presidency. And if it was, then it was deep state accomplished it, I think, spectacularly. If you want to absolutely make sure Trump is a lame duck and Republicans lose the midterms, get Trump to attack Iran 9 months before the elections.
The barracks that was struck in Jordan.
Look at that. How many people in each of those houses? I mean, I assuming guess.
But you're assuming that troops have not been evacuated from those barracks.
Yeah, they probably ran out of the dormitories when the warnings came out.
All the early warning radars are smoked, man. There's no early.
No, and the early warning radars are definitely heavily damaged.
But they still have 90 seconds of warning, which.
But how many in each of those barracks? I'd count maybe 30 people, right? And bump it. I mean, anyway.
But assuming that they're there, I just want to say maybe we don't know if they've evacuated or not. Just on the question I have is on the. You mentioned at the beginning about the arbitrage opportunity, and you gave an example to the Irish and the diapers in Norway, whatever, and I think it's Norway and Sweden. What was the example you were given? What's the arbitrage opportunity right now in the oil markets?
Are you asking for investment advice?
No, because I was taking a note when you were explaining that, and I remember hearing the diapers and stuff. I'm not sure if I missed something.
No, I was just saying that that's possible in a market that I'd call it horizontal, right? In a horizontal market. And what I mean by that, okay, let me be very specific about that. If you're in Norway and you want to buy the diapers are right there, right? There's no border. It's a free trade zone. You can cross it if you want. And the diapers are there and the price is there. And you can buy as many of them as you want. In Northern Ireland, if the sterling goes down, the price of cigarettes and tobacco goes down, there's no trade border. You can just drive across, you can buy them. Now, in 2 weeks, they'll readjust the cigarette and alcohol prices. So you got to get in there quick, right? Those are straightforward arbitrage opportunities. In financial economics, that's often called picking up dollars on the ground, right? So financial economists often say dollars, you'll never find dollars on the ground because they'll always already be picked up. It's a little bit of a paradox, but it kind of makes sense. Genuine arbitrary opportunities are kind of like that. The issue with the way that the price manipulation is going in the oil market is it's not like that. You're taking positions on future things. You're saying so if you go, okay, they're juicing the oil market or whatever, I'm going to take a long position in oil. Okay, great. But now you're going to have a margin in that. And if you're wrong and they just juice up the manipulation even more, you're going to get smoked, right? So that arbitrage stuff doesn't work in a
I
forward-looking.
I got it.
Yeah, it doesn't work in a forward-looking market that is not returning to its mean, as you said. That's not
I got
returning.
it, I got it.
That becomes highly, highly unpredictable. Now, can you trade that as a smart person? Yeah, maybe. It's risky.
Because my next question was,
You trade the oil stocks and not the futures, and you don't. Yeah, if you'd bought oil stocks at that low, you'd be doing really well right now.
why don't big, these monarchies or another country or whoever, knowing what you've just explained, make money of it, saying, holy shit, it's all being manipulated. Then we go buy oil futures at those cheap prices, knowing that it will revert back to the mean. And you've explained is that's assuming that it will even revert. Sometimes market manipulations could last, as you said, this one you believe has been lasted for years and years. Market manipulations could last for years. It could liquidate you.
There's an old phrase about this from Keynes, the economist Keynes, where he said, markets can remain irrational longer than you can remain solid. That's always true, but it's particularly true if there's insane manipulation that you can't.
If you're betting against the US government, you're betting against the Treasury that can print money.
Well, if you understand what the manipulation is, and you were like me, who, come on, thank you, who right at the start of the crisis said they're going to keep oil under 100 for at least 2 months or longer if they can, then you don't trade that. Now, once it's gone down, now is when you trade. This was a perfect time right here to buy oil stocks.
And by the way, they are going to lose this war. They're going to lose this price manipulation war. But I don't have any predictions as to when. But this week is looking rough, man. They're throwing the kitchen sink at this, and they can't get it back down to $80 a barrel. Maybe I'll eat my words and it'll be 80 this day next week. But they're having a much harder time pushing the price down this week than they were last week.
No, they aren't even trying. That's the key thing. You have to understand. That's one reason I'm so confident that it'll go upwards. Remember that Bloomberg video we just watched? They've accomplished. They've crashed the price of oil.
By the way, they are going to
that
lose.
That isn't
This
a one.
war. They're
This one.
The Houthis are saying they targeted two sides.
They're not trying to push down the price of oil anymore. They're trying to push it upwards, the media.
It's getting a bit out of control. The other thing, an interesting question.
Before, the corrupt Epstein crowd needed it to stay below 100 to make money, to not lose money. Now they've repositioned themselves up at 150. They need the oil market to go up to 150, and so that's where it's going to go.
If anyone's in investment markets, this is not investment advice. I want to be completely clear. But given the fact that
investment advice.
no, that's a very specific legal criteria. But given the fact that the crack spread's very high, margins are high, gross margins are higher, whatever way you cut it, any energy company with any refining capability should be earning money out of this, no matter what the WTI price says. The energy company stocks, the majors like Petrobras, Suncor, Chevron, these guys, Exxon, they are correlated to the WTI futures. That's because algorithms trade them, right? It's the same problem because they trade the beta on those. But the thing is, like, logically speaking, when the earnings come in at the end of the quarter or whatever, the earnings are going to be high, like they should be. The other really interesting thing that's happening that I found out in the stock market is the oil majors. So those are like the actual oil. They drill the oil and they often have a refining component. They're tracking the WTI futures as they usually do. The pure refiners, so there's a bunch of companies that you've never heard of that are just pure refiners. They don't do any oil extraction or production. They only do refining. Those things are going to the moon. They're not being affected by this manipulation. And my theory is because they're correlated not to the WTI price, they're correlated to the crack spread because they're refiners and that's the gross margin. So but anyway, the TLDR on that is basically the market is so broken. It makes no fundamental sense if you look at it. It makes no sense. I looked at Suncor. It's a Canadian.
Well, to me it makes sense, but I'm looking at it through a lens that yes, there's market manipulation.
Energy company. 50% of Suncor's profits come from refining. 50% come from production extraction. Right. So it should behave like a refiner stock because 50%. It's not. It's just tracking WTI. It makes no sense. They're making money hand over fist on their refining. I mean, I can't see it now because we don't have the earnings, but it's just logically obvious. Now, are these things that people are going to be picking up dollar bills? Are smart fund managers looking at stuff like this? Yeah, I think so. But that's not going to break the oil price. That's not going to break the oil price. So when you see dislocations and...
Yeah, a good way indirectly making money from this dislocation is not by betting against it. It's by betting about the what is it, second and third order consequences from it. like the oil companies, not the integrated oil companies, but the refiners mainly. Printing.
Yeah, and when you see a market in that state, like it's a screwed up market, man. Something's going on. But I don't think this is going to last. Well, I don't think this is going to last. Maybe I should go apply for another.
Next time, exactly.
Maybe it's not going to. Maybe it's not going to last. I think we're very, very close to this whole thing breaking down now. I mean, I just cited the SPR numbers and stuff. That's the physical reality. And diesel is just looking nuts these days. Yeah. And the crack spread, the crack spread wasn't exploding this week, but it didn't come down. And I don't know if you've seen, there's this hilarious chart on X at the moment, because, you've seen the chart with the crack. So the crack spread and the WTI usually move together, and now they diverged, obviously, and that's like weird. That's the weird thing. And they have a great chart where the oil price is a shark and the crack spread is a swimmer. And we're watching the shark come up to the swimmer. When the shark catches the swimmer, like I think we're in like Mad Max. We're in like Road Wars, and we're fighting each other over petrol.
Yeah.
Philip,
we're going to Mad Max and fighting ourselves over petrol. That is the second half of the summer. Let's look forward to that. In any case, this was an interesting video. I expect oil prices to go up a lot more. And that's because you have to understand, now, unlike before where the media was talking about oil glut, now mainstream media is pushing, we're in trouble, we're oil shortage, and oil prices are going up past 120. That you heard they'd be in the Bloomberg video that we're going to be testing 120 again. So now mainstream media is locked in, pushing oil prices up. So that's where they'll go. This will be on YouTube. Like and subscribe. Come watch on Kick or Twitch, and I'll see you next video. Bye.